If you've been trying to follow the financial markets lately, you've probably got a serious case of whiplash. I mean, one minute, crypto is the bad guy, dragging everything down. The next, it's the hero leading this huge rally. So what on earth is actually going on? Let's dig in and figure this out.
And that's the big question, right? How can the market crash one day and then rocket up the next? The signals are completely contradictory, and it's got a lot of people just scratching their heads. Is there some kind of hidden logic here, or is this just pure chaos? Well, we're going to follow the clues. I mean, just look at this. This perfectly sums up the confusion. You've got a huge outlet like Bloomberg telling two completely opposite stories, just 24 hours apart. Yesterday, crypto was the villain. Today, it's the hero. Now, this isn't just a different angle. This is a head-on collision of narratives. To get the real story, we have to look past the headlines. All right, so our first clue. This one takes us into the world of big institutional money. Something huge just shifted with one of the biggest players in finance, and it looks like it's a key piece of this whole puzzle. So while all the headlines were screaming crash, this number right here tells a totally different story. $58 million. That was the net inflow, money coming in to Bitcoin ETFs on a day that was supposed to be a total disaster. So the question is, where did all that cash come from? And this is where it gets really, really interesting. When you break it down, a clear pattern emerges. For Bitcoin ETFs, you see that plus 58 million, with giants like BlackRock just pouring money in. But look at Ethereum. It's the opposite, a $9 million outflow. So you can see this isn't just random cash sloshing around. This is a targeted move, with the big institutions clearly favoring Bitcoin right now. And here it is, the smoking gun. A Bloomberg crypto analyst pointed out that this big surge in Bitcoin happened on the exact same day that the investment behemoth Vanguard reportedly lifted its ban on Bitcoin ETFs. I mean, come on, that is not a coincidence. This is what people are calling the Vanguard effect. And it's way more than just a price bump. It's a huge stamp of validation for crypto as a legit asset. Okay, on to our second clue. For this, we need to zoom out from the frantic day-to-day market action. Because while prices are jumping all over the place, there's a much slower, much more powerful force at work behind the scenes: regulation. The actual future of digital money is being decided as we speak. Now, before we get into that, let's do a super quick refresh on stablecoins. Just think of them as the essential bridge connecting old-school finance and the new world of crypto. They're built to hold a steady value, usually one-to-one with the US dollar, which makes them crucial for trading. And understanding them is absolutely key to understanding this next big fight. So a foundational law for stablecoins is already on the books. But that was just the starting pistol. The real work is happening right now. Agencies like the SEC and the Treasury are in the weeds, writing the specific rules of the road. And they've got until July 2026 to get it all done. But the decisions they're making today are going to define this industry for a long, long time. And this right here is the heart of the whole debate. Are these new regulated stablecoins going to run on open public networks like the internet that anyone can build on, or will they be locked down in private corporate systems that are controlled by the big banks? You've got this huge philosophical battle, the open source spirit of crypto versus the walled garden of traditional finance. It's a massive fork in the road. And you better believe the big players are not waiting around to see how this plays out. Just look at PayPal. Ever since that framework law was passed, their stablecoins market cap has absolutely exploded, from about $1 billion to nearly $4 billion. That tells you everything. They are already getting in position to try and dominate this new regulated world. The race is definitely on. Okay, clue number 3. This one's all about what's going on inside traders' heads, the psychology of the market. Because right now, there is a full-blown war raging between the bears, who are full of fear, and the bulls, who are full of optimism. So on one side, you've got the pessimists. A key signal here is something called the funding rate. The easy way to think about it is it's the cost to bet on which way the market's going to go. When that rate turns negative, it means so many traders are betting the price will fall, they actually have to pay extra just to make that bet. And lately, that indicator has been flashing bright red. But here's the thing. There's a total flip side to that argument. You have analysts, like the ones at Sentiment, who are contrarians. Their whole thing is when everyone is panicking, when fear is at its absolute peak, that's exactly when a big rebound is about to happen. For them, extreme pessimism is a massive buy signal, because it probably means all the sellers are already out.
And we have a perfect, real-world example of this theory in action. MicroStrategy, a company that holds a ton of Bitcoin, saw its stock bounce back 16% right after the market hit what analysts were calling the peak of fear. I mean, that's pretty clear evidence, right? The moment of maximum panic, that was the bottom. Okay, so let's recap. We've got our three big clues: a huge wave of institutional money, a quiet but intense regulatory battle, and this psychological war happening between traders. So, what does this all mean when we put it together?
So here it is. The reason the market feels so chaotic is because it's not being driven by one thing. It's in the middle of a massive tug of war. You've got this incredible bullish force of institutional adoption pulling it up. At the same time, you have this heavy bearish force of negative trader sentiment trying to drag it down. And underneath all of that, the tectonic plates of regulation are shifting, creating all this uncertainty. The result? Exactly what we're seeing: crazy volatility and totally conflicting signals.
And that leaves us with one final, really important question. The game has changed. The big Wall Street giants are in, and the regulators are drawing up the new rules. So are we watching the end of crypto's Wild West era? Or is this actually the start of a much bigger, much higher stakes battle for control over the future of money? What we're seeing now, it might just be the opening shots. If you found this explainer helpful, be sure to smash that like button and subscribe so you don't miss your next Daily Edge. More news in our Telegram channel in the first comment. See you next time.